Many people believe the stock market is nothing more than a rigged game, controlled by sharks, hedge funds, and big players who manipulate prices and profit at the expense of small investors. We've all heard stories of Wall Street insiders making billions, while ordinary traders get left holding the bag. But here's the real question. Is that actually true? Who really controls the market? And most importantly, can small investors like you and me still make money in a world dominated by giants? The answer might surprise you, because while money and influence do matter, the real driver of markets hasn't changed for centuries. From the South Sea bubble in the 1700s to the roaring 1920s to the dot-com mania of the late 1990s, the patterns repeat again and again. Which brings us to a truth that every successful trader eventually learns. It isn't about who you think is pulling the strings. It's about understanding what truly moves the market. At its core, the market is driven by one simple force: the flow of money. Prices rise when new money comes in, when buyers are willing to pay more than the last trade. Prices fall when those buyers step aside and sellers are forced to accept lower bids. It sounds almost too simple, but this mechanism has been the same for centuries. But money alone doesn't explain the full picture. Behind every trade is human psychology. Fear, greed, and the urge to follow the crowd shape market behavior far more than most people realize. When investors see others rushing in, they don't want to be left behind. When panic sets in, they sell at any price just to escape. History is filled with examples. During the dot-com bubble of 1999 and 2000, investors were willing to buy internet stocks with no earnings, no business model, and sometimes not even a product, simply because everyone else was doing it. Prices soared to absurd levels and then, almost overnight, collapsed.
The same psychology drove the housing bubble before 2008. Banks, rating agencies, and homeowners all believed a single story: that housing prices could never fall nationwide. That belief fueled reckless lending, over-leverage, and record home building. When reality finally hit, the system unraveled and nearly took the global economy with it. These events remind us of something critical. Markets don't move just because of news headlines or because big institutions decide to push prices around. They move because humans, whether they're Wall Street professionals or everyday investors, keep reacting to the same emotions over and over again. And that brings us to an even bigger question. If human nature never changes, and if big money clearly has advantages, then is trading really a fair game for small investors like us?
Now, let's be honest. Big money does have advantages. Institutions and hedge funds operate with more data, faster execution, and larger positions than any individual trader could ever dream of. They hire PhDs in mathematics, run algorithms that trade in microseconds, and sometimes even co-locate their servers next to exchange data centers just to gain a millisecond edge. With that kind of power, they can absolutely influence short-term price action. But here's the part most people overlook. Their influence is not invisible. Every big order, every attempt to push the market leaves a footprint on the price chart. Liquidity cannot be hidden forever. When a hedge fund accumulates a massive position, the buying pressure shows up in rising prices and volume. When they unload, the weakness becomes just as clear.
That's why retail traders aren't powerless. The playing field isn't perfectly level, but it isn't unwinnable either. If you learn to study price action instead of chasing headlines, you can spot the footprints institutions leave behind. And this truth is not new. In fact, it's as old as human behavior itself. The Bible puts it simply: there is nothing new under the sun. Applied to the markets, this means that no matter how advanced trading strategies become, no matter how sophisticated the technology gets, the underlying patterns remain the same.
because people, driven by fear, greed, and hope, haven't changed. More than a century ago, one of Wall Street's greatest traders captured this idea perfectly. His name was Jesse Livermore, and his timeless insight still shapes the way smart traders think today. If there's one figure in Wall Street history who embodies both the promise and the peril of speculation, it's Jesse Livermore. Born in 1877, he started trading as a teenager in so-called bucket shops, offices where customers could bet on stock prices without actually buying the shares. By studying price patterns, he quickly gained a reputation as a boy wonder, earning thousands of dollars before most kids his age had even finished school. But Livermore's story wasn't just about early success. Over the course of his life, he made and lost several fortunes. At one point, during the Panic of 1907, he famously shorted the market and reportedly made $3 million, an astronomical sum at the time. Later, in 1929, as Wall Street reached its most frenzied peak, Livermore once again went short. When the crash came, his bets paid off spectacularly, earning him over $100 million, a fortune that would be worth nearly $2 billion today. For a brief moment, he was one of the richest men in the world. And yet, just as quickly as he built his fortune, he lost it. The volatility of markets, combined with his own battles with discipline and personal struggles, eventually left him bankrupt more than once. Still, despite his turbulent life, Livermore's insights into trading remain among the most quoted and respected in financial history.
Perhaps his most famous line was this: "There is nothing new in Wall Street." There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. What did he mean by that? Simply put, the surface of the market changes. New companies emerge, new technologies appear, and new instruments are invented. But the underlying human behaviors never change. Greed, fear, hope, and panic drive people to make the same mistakes over and over again. You can see this truth play out in modern times. In 2021, meme stocks like GameStop and AMC soared as retail traders banded together on social media to push prices higher. For some, it was about sticking it to Wall Street hedge funds. For others, it was simply about chasing quick profits. The frenzy echoed the bucket shop speculation of the 1920s, when ordinary Americans would bet their savings on rumors and momentum, often with little understanding of the risks.
The same psychology appears in cryptocurrency markets. The explosive rise of Bitcoin and other digital assets has created fortunes and wiped them out. When prices climbed, investors poured in out of fear of missing out. When prices fell, panic selling often followed. If you strip away the technology and the modern branding, the dynamics are nearly identical to the South Sea bubble of 1720, when investors across Europe threw money at a company promising riches from overseas trade only to see it all collapse. This is the enduring lesson Livermore left behind. The players change, the technology changes, but human nature does not. Whether it's 1720, 1929, or 2021, the same patterns repeat because the emotions driving human behavior are timeless. And for today's small investors, that truth is both a warning and an opportunity. Because if markets will always reflect the same cycles of greed and fear, then the real question becomes, how can we position ourselves to recognize those cycles and profit from them? That brings us to the most practical part of this discussion, what small investors should actually do.
If Wall Street has speed, data, and size on its side, how can individuals like us possibly compete? The answer is surprisingly simple. Stop focusing on the noise and start focusing on what actually matters. The market speaks through price action. News headlines can be misleading, Analyst opinions can be biased, and social media hype can come and go in a flash. But price and volume tell the real story. When a stock breaks out on heavy volume, that's demand revealing itself. When a rally stalls and volume dries up, that's a warning sign. By studying trends, breakouts, and corrections, individual traders can see the footprints institutions leave behind. This requires discipline and patience. Most investors get into trouble because they chase hype. They hear about a stock going to the moon and rush in after it's already run up. Or they panic at the first sign of a pullback and sell right before the stock recovers. The key is to wait for confirmation in the charts. Is the stock breaking out of a sound base with strong volume? Is it holding key levels during corrections? Are the risk and reward balanced in your favor? These are the questions disciplined traders ask.
Equally important is risk management. No strategy works all the time, and no trader wins on every trade. The difference between those who survive and those who don't often comes down to controlling losses. Setting stop losses, limiting position sizes, and protecting capital may not be exciting, but they're the foundation of long-term success. Now, some people will argue that small investors are always at a disadvantage, but history proves otherwise. In fact, some of the greatest trading success stories come from individuals who started with little more than knowledge, discipline, and determination. Take Dan Zanger, for example. In the late 1990s, he turned just $10,000 into over $42 million in less than 2 years by trading chart patterns in momentum stocks. He didn't have a hedge fund or insider connections. What he had was a sharp eye for price action and the discipline to stick with his rules.
Or look at Mark Minervini, a U.S. investing champion and one of the most respected stock traders alive today. He started as a retail trader, studied chart patterns obsessively, and developed his own strategy. Over the years, he's achieved returns that rival or exceed many hedge funds. And he's not alone. Every year, in the U.S. Investing Championship, new individual traders step into the spotlight with extraordinary returns, often outperforming Wall Street professionals. These aren't billionaires with supercomputers, they're independent traders, people just like us, who prove the game is still fair for those with the right approach. One of the most famous experiments in trading history also supports this idea, the Turtle Traders experiment, conducted by Richard Dennis in the 1980s. Dennis believed that trading success was not about having special talent, but about following clear rules. To prove it, he took a group of people, most of whom had no background in finance, and trained them in a simple trend-following system. Within a few years, many of these so-called turtles had made millions of dollars. The lesson was clear. With discipline and a proven system, even complete beginners could build wealth.
All of this points to a critical mindset shift. Instead of worrying about whether Wall Street giants are unbeatable, focus on what you can control, your knowledge, your rules, your discipline. The market may be dominated by institutions, but they cannot hide their moves. Their footprints are there for anyone with the patience to study them. And that's the real opportunity for small investors. You don't need inside connections or billion-dollar funds to succeed. What you need is the willingness to learn, the discipline to follow your plan, and the patience to let your edge play out over time. As Jesse Livermore once said, history keeps repeating itself because human nature never changes. That's just as true for retail traders today as it was a century ago. Which brings us to the most important takeaway. Thriving in the markets isn't about outmuscling Wall Street. It's about outlasting your own emotions and following the timeless patterns that have always been there.
As we've seen throughout history, there really is nothing new under the sun. Whether it's the South Sea bubble of the 1700s, the roaring speculation of the 1920s, the dot-com boom of the late 1990s, or the meme stock frenzy of 2021, markets have always been driven by the same timeless forces: money, psychology, and human behavior. The players may change, the technology may look different, the names of the companies may be new, but the emotions that drive investors, fear, greed, hope, and panic, remain exactly the same. And that's why the patterns we see on charts, the cycles of boom and bust, keep repeating again and again. The truth is, you don't need to outsmart Wall Street to succeed. You don't need insider information, and you don't need billions of dollars under management. What you need is the ability to recognize these patterns, to study price action instead of getting lost in the noise, and to build the discipline that allows you to act with patience instead of emotion.
History has already written the lessons. Traders like Jesse Livermore, modern champions like Mark Minervini, and even the Turtle Traders experiment all point to the same conclusion. The market rewards those who respect its timeless rules and punishes those who ignore them. So here's the bottom line. Markets will always repeat, but how you respond, that's what makes the difference. If you found this helpful, make sure to subscribe for more deep dives into market psychology and timeless trading wisdom. Drop a comment below with the lesson that resonated most with you, and share this video with someone who needs to hear it. Because while there's nothing new under the sun, the opportunity to learn from history and to profit from it is always there for those who are willing to listen.